Great. Thank you very much. Thank you, everyone, for being here. My name is Admin Cotter. I'm from DZ Bank, from the Singapore branch of DZ Bank. I'm very pleased to be with you here today with our speakers and our partners from the EU, from the UNECE, and the high-level climate champions as well, of course. A few logistical notes to begin with. This is a so-called silent conference, like a silent disco. So you all have these headsets. You can hear the conference through that. Obviously, this is being streamed at the same time. But when you also want to ask questions at the Q&A later, we're going to have Slido available. And I think that, and we have the QR code for Slido. So if you're able to submit your questions through that, I think we will have it up there for a few moments. So it gives you a chance to get your phones out. But also to make this session a bit more interactive, we'll have some polls with Slido as well later on as well. So I know we're running a bit late, so I want to make as quick a start as possible. And with that, I would like to introduce, we have four keynote speakers, sorry. And I'd like to introduce our first keynote, Siegfried Ruhl, horse class advisor to the European Commission, especially when the Director General of Budget. Thank you. Siegfried.
Thank you, Adam. Ladies and gentlemen, also from my side and on behalf of the European Commission, a very warm welcome to all of you here in the room and in front of the screens. Today, I don't want to philosophize about what should have been done or what could have been done. Today, I want to talk to you about what we have done. But not to be proud of what we do ourselves, to praise ourselves. We know we also have to do more. The purpose is to inspire you by showing what we, the European Commission, have done, to catalyze the power of transition, and to encourage all of us to become part of the solutions. Today is about translating implementation into impact. Inspiring others means convincing them with our own actions. The European Union used the pandemic to turn a crisis into an opportunity. With our recovery program, Next Generation EU, we invest more than 700 billion euros in a greener, more digital, and more resilient Europe. At least 37% of the spending of our member states' recovery and resilience plans needs to be used for sustainable investments. Greening is a question of consistency. This is why we logically also fuel our green investments with green funding. Therefore, we will raise up to 30% of the Next Generation EU green funds through the issuance of green bonds. We immediately put our words into action. Within a very few months, we established the EU as an issuer in the green bond market. This was also possible because Europe was, in a way, quite avant-garde here for that. Already in 2007, the European Investment Bank issued the first green bond, at this time called Climate Awareness Bond. Until today, we brought up around 50 billion of green bonds to the market, and our program has the potential to grow to become the largest green bond program worldwide. Our green bonds are built on solidity and trust. On the one hand, financially, they are as safe as bonds can be, backed by the European Union, by the European taxpayer. On the other hand, they are as green and as transparent as a bond can be, complying with the golden market standard at the moment, the ICMA green bond principles. But also we are doing more. We have a dashboard on our website where all our investors can dig into the detail what is exactly financed with the EU green bonds. And this morning, our Commissioner Johannes Hahn presented the first NGEU Green Bond Allocation and Impact Report. With this allocation and impact report, we measured the first time ever the impact of our green bonds. The full implementation of all measures we can lead we do can lead to a permanent reduction of 44 million tons of greenhouse gas emissions every year, which is equivalent to 1.2% of the aggregate EU greenhouse gas emissions, or equivalent to the annual emissions of over 4 million households. In addition, we put a price on carbon, which contributes to reducing the emissions. To date, the EU emission trading system, the EU ETS, has helped to bring down emissions from power and industry sectors to 37.3% below the 2005 levels. The revenue, in turn, helped to support climate and energy action. Member states used 76% of their ETS funds for this purpose. These are just two examples which prove green financing serves as a catalyst of transition, and its impact is significant far beyond the financial aspects. It works as a trigger for development of green standard-setting technology and inspires others to become part of global efforts tackling environmental challenges. The European Union is committed to further encourage sustainable investments on different levels by developing further the framework to ensure that the financial investments achieve really the impact which is desired. By advancing sustainable investments, for example, green and sustainable securitization, and by promoting a global green bond initiative to expand the green bond markets in partner countries to finance climate and environmental projects. When I'm promoting our green bonds to investors, I really feel that there is a global demand and a strong political and economic will and vital interest to tackle the biggest challenges of our time. Our and other green bonds allow investors and markets to be part of the solution. In return, they offer the highest return possible. They are not only financially attractive, they are also a real investment for our children and the climate they will be living in. In this stance, sustainable finance is an indispensable part of the solution to transition to a carbon-neutral economy. Our next generation EU green bonds fulfill, faithful to their name, a promise to the future. They demonstrate that the effort in developing the market for sustainable finance creates an impact. So let's continue with this effort to our benefit and to the benefit of the next generations. Thank you. And now, it's a pleasure to hand over to Suat Benkrada from DZ Bank.
Ladies and gentlemen, good afternoon. On behalf of DZ Bank, I warmly welcome you to this expert-level event on transition finance, from implementation to impact. My name is Suat Benkrada. I'm a board member of DZ Bank, and I'm responsible for the capital markets and the group treasury business. First of all, I would like to thank our host country, the UAE. It's always great to be here. I first came here in 2008, and we talk today about implementation and impact, and I can say that I've witnessed the vision, the implementation, and the impact the UAE has been having and is still having since I first came here. Excuse me, please. I would also like to thank all of you who have taken the time to be with us in person today, and those of you listening to us on the online channels. I would also like to thank Siegfried Ruhl, EU DG Budget Specialist, Dario Liguti, Mazen Sweden, and of course our distinguished speakers who we will hear from very shortly. Many of us here today can make an active contribution to the sustainable transition. We, banks, in our role as market intermediaries, can show our clients the possibilities of sustainable finance and generate and promote deal flow. Investors, you can communicate your sustainable investment needs and goals and become an active companion of a credible transformation, living the new credo, transform instead of divest. Issuers, you can realize the potential of issuing sustainable bonds. You may be sitting on a pool of sustainable assets that can support the transition in a positive way. Within DZ Bank Group, we recognize the need for change and the opportunities this could bring. As many of you know, excuse me, please, I think I need some water. Sorry, just 1 second. Sorry, we're just human beings, and I just needed some water. Thank you for your understanding. Within DZ Bank Group, we recognize the need for change and the opportunities this could bring. As many of you will know, a core priority for DZ Bank is aligning our business portfolio with the 1.5-degree target of the Paris Climate Agreement. We work with our customers to support the transformation of the economy towards greater sustainability and the vision of a net zero future. DZ Bank Group not only advises clients on the topic of transformation, but also leads by example. This is illustrated in our businesses. Our loan commitments in renewable energies grew in 2022 to around 6.5 billion euros. We supported placements of green, social, and sustainability-linked bonds with a total volume of more than 43.4 billion euros. Union Investment, our asset manager, is one of the market leaders with 122.4 billion euros of sustainable assets under management in accordance with the EU Sustainable Finance Disclosure Regulation. We have also set specific climate targets and decarbonization pathways in 5 CO2-intensive industries that account for a significant share of global CO2 emissions: energy, automotive, steel, cement, and aviation. The sectors under review currently account for around 13%, of our total lending volume. At the end of 2022, the CO2 intensity of the business portfolio in these 5 sectors was 62% lower than the corresponding reference value based on the International Energy Agency's net zero calculations. Building on this, we aim to further reduce the CO2 intensity of our lending business and of our own business in the sectors under consideration. And we also aim to reduce it almost completely by 2050 at the latest. But what is transition finance? To you here today, it may mean different things. Unlike sustainable or green finance, which raises financing for green projects, transition finance seeks to raise capital to transition brown industries. Not all sectors can go green overnight, but as a critical enabler of climate action, transition finance should be used to help carbon-intensive businesses decarbonize. And although carbon emissions receive much of the attention, deforestation, water shortages, and soil erosion are also serious environmental problems that should not be neglected. A successful transformation agenda requires inclusive partnerships at global, regional, national, and local levels, built upon principles and values and upon a shared vision and shared goals, placing people and the planet at the center. And it requires innovative tools and instruments for financing the challenges in the sustainability context. Most of these investment needs will be in developing countries where the impacts of climate change are expected to be most severe, and many of them need to happen in the so-called hard-to-abate sectors of the economy, and often at the level of small and medium enterprises. We understand that investors are concerned about the risk of overpromising and under-delivering or transition washing. However, intentional misinformation is not the main issue. The main issue is hopeful commitments without a clear plan on how to get there. It is therefore important that transition finance is not viewed as less ambitious than pure green finance. We need clear, ambitious transition plans in every country, every industry, and every company. Investors are expecting the development of comprehensive plans that are both ambitious and trustworthy, and they may well soon be a company's license to operate, becoming a foundation of the global race to net zero. While this is a tremendous challenge, DZ Bank sees the global transition as an opportunity for long-term growth and stability for everyone. Take up this challenge together with us and fight to preserve a livable blue planet for our children, grandchildren, and generations to come. Thank you very much for listening, ladies and gentlemen, and the floor is now yours, Dario. Thank you.
Moderator, how are we doing on time?
It's fine.
It's fine, great, excellent. So, ladies and gentlemen, good afternoon. I'm Dario Ligutti, and I work for the United Nations Economic Commission for Europe. And I would like to pick up from where Siegfried left his speech and what we heard this morning at the high-level event on transition finance, and a little bit as well on a practical experience that we've been having with the climate champions over the last 2 years. So we asked ourselves the question, we know that we need a lot of money for the energy transition, and we know that green finance is a market. We heard the great things that the European Union is doing in the green bonds, in the development of the green bonds market and the carbon market as well. And they say, but that's not enough, of course. And that leaves a big area around transition, which is not attended by existing financial flows, which goes under the name of transition, as what mentioned before, very specifically. So how do we do that, and how concretely what happens? So about 2 years ago, we embarked with the climate champions around the world, us and the other 4 regional commissions, in looking in, talking to sponsors, project sponsors, corporates and, renewable energy project sponsors, companies that wanted to invest into decarbonizing their industrial processes, to understand why they were not getting the funds that they were looking at. And then we spent half of the time with them and the other half of the time with financiers, understanding why you're saying there are no bankable projects out there. Because you have on one side, the finance community says there are no bankable projects, and the industrial, the real economy community says there is no money coming to our projects. So we wanted to understand what's the gap, what's happening here. And so we went around, we looked at 450 projects. The result of this work was presented at last COP, about 100 projects of them. At this COP, we're presenting the follow-up to those projects, because obviously, financing, it takes some time. It's a long process to get to match financing with investment projects. And a number of issues came out. Obviously, the fact that there are transition finance, as Swat said, is a complex dynamic. You have green taxonomies. On one side, the EU is very famous, the green taxonomy in the EU, but you have somebody counted 47 taxonomies around the world, I think, this morning. So you have 47 standards, at least you can say. No, they're all different, but at least you have 47 standards. You don't have transition standards, because it's difficult to put a standard or something which is moving all the time, transition. But you have transition principles. We have the whole financial community working as we speak, the GFANs and the asset managers for Net Zero Coalition, and a number of other organizations working alongside, fixing some principles, supporting the creation of an asset class, of a market which can be called an asset class, which can integrate the green bonds that Siegfried talked just a few minutes ago. And so that was one of the issues, the first one. The second one was, the second directly is lack of information, or the complexity out there when you're looking at, you have a project, when you're looking for a financier, where to go. So, different funds, different requirements, different processes, all very cumbersome most of the times. That's one of the things that a lot of people lamented. And we heard the result of this was recently announced yesterday, I believe, or the day before yesterday, about this large initiative from the World Bank supporting standardizing, making simpler financial applications from project sponsors. You heard the large initiative the NDBs are launching on this. And so that's a concrete example of the work that we have been bringing forward over the last 2 years. A number of other issues, of course, is around the risk involved in transition finance projects, whether it's political risk, of course, when you're looking at emerging markets, but as well financial conditions, new technology risks. Most of these transition projects include as well innovative technologies, which not all of the times you know where they will end up. And so here you have the necessity of partnerships like the one that we have with the private sector, with the MDBs, in creating financial products and insurance products that support, that take out those risks, that mitigate those risks, so that makes those financial conditions attractive for the project sponsors to implement their projects. And this is something that we need to remember. When you are looking at the transition, you are substituting capital, which is actually working right now, is working well from a private perspective, but working bad from a social perspective, because it's not taking into context the externalities that the capital, while it's being used, is creating. Substituting that capital, which most of the times is amortized as well, so it's a cash cow, what they call, into another sort of capital to do exactly the same thing, but without the externalities. And this is the conundrum around transition finance. How do you make these operations economically viable, economically interesting for the private sector, for a project sponsor, but as well for a financial institution who wants to finance that, who expects a return on capital on their financing? And I think this is where we've been concentrating our efforts. We continue working. I cannot spoil you the results of this work because it's taking place tomorrow. So if you join us tomorrow, you'll know what has been the result of this mixed picture, I would say. I'll just tell you that. But there is some hope. I think the Siegfried, what mentioned just before, and the discussions that we had this morning, the examples from Uruguay as well, and from Prudential that they brought to the table this morning, showed that it is possible. There are solutions out there. It's a question of being together and a question of or partnering up different partners as we are here around this room, and I think that's the way forward. And with that, I thank you very much for the attention. And I give the floor to Master Swedan. He is the lead, let me tell you. I said his title is about, hold on, let me tell you. Emerging Markets and Developing Economies lead the Climate Finance Champions team. Thank you very much. Thank you.
Dario, thank you very much. Ladies and gentlemen, good afternoon. It is my pleasure to deliver a short intervention today on behalf of the UN Climate Change High-Level Champions on this critical topic of transition finance. A thank you to the European Union for hosting and for its invitation. As you will no doubt be aware, finance has been a critical element in the UN Framework Convention on Climate Change and the Paris Agreement from the outset, with Article 2.1c of the agreement calling for all financial flows to be consistent with a pathway towards low greenhouse gas emissions and climate-resilient development. The latest UN estimates of required investment in support of climate action range between $1.6 to $3.8 trillion per year between 2020 and 2050. Finance's importance as an enabler and accelerator to achieving the necessary transition of the global economy through investing in net zero, adaptation, resilience, and natural capital cannot be overstated. Building on the discussion at this morning's high-level event, my fellow speakers here have each touched on key elements pertaining to the specific topic of transition finance as practitioners. Amongst others, the goals of transition finance, the need to develop and agree a common framework for all stakeholders to adhere to, and the effectiveness of the bond capital markets and carbon markets to fund the required transition. All are independently and collectively important elements for delivering on the required decarbonization especially within the hard-to-abate or heavy-emitting industries, which today, as per a recent article by Mark Carney, UN Special Envoy for Climate Action and co-chair of GFANZ, generate almost 1/3 of global emissions. So in this context, I will speak very briefly on 3 areas where the climate champions are offering support to efforts to mobilize and scale up transition finance. Firstly, there is our 2030 Breakthrough Agenda, an unprecedented international clean technology plan to help keep 1.5 within reach. Through a coalition of leading public-private and public-private initiatives, the Breakthrough Agenda provides a framework for countries and businesses and civil society to join up and strengthen their actions every year in key emitting sectors, including but not limited to chemicals, energy, materials, and transport. Bringing together the tools of government with business and financial ingenuity, the Breakthrough Agenda aims to make clean technologies and sustainable solutions the most affordable, accessible, and attractive options to all in all regions by 2030. Importantly, in the context of the global stocktake, the initiative's outcomes provide clear guidance on where high-emitting sectors are now and where they need to get to towards 2030, providing an excellent resource for both the parties and the private sector. Our dialogues as the champions this week at COP28 with parties and concerned stakeholders will include the 2030 Breakthrough Agenda, noting that we are holding thematic days and events covering all key sectors over the course of the 2 weeks. Secondly, through our partnership with GFANZ, a global coalition of over 550 leading financial institutions committed to mainstreaming the decarbonization of the global economy to reach net zero emissions by 2050, we are encouraging financial institutions to develop their own science-aligned transition and decarbonization plans and to build capacity. Importantly, to deliver not only capital but expertise, especially in developing countries, and to not only clean energy, as critical as that is, but also to hard-to-abate sectors, both committed and committing to decarbonization. Encouragingly, inaugural transition plans are emerging from the finance sector to guide actions following both GFANZ and Race to Zero guidance. Finance sector transition, finance principles, and transition plans based on GFANZ guidance will be critical to harmonization and good practice. Noting also that together with a group of multilateral development banks and other donors, GFANZ on Friday announced the launch of a new coalition aimed at improving climate-related technical assistance for financial institutions in emerging markets and developing economies. This follows on from another important announcement by GFANZ a couple of months ago when it launched a consultation on transition finance strategies and measuring the impact on emissions. Thirdly and finally, developing country climate finance needs continued heightened focus. Most of the transition finance and investment required to shift the world's energy and transportation systems to low-carbon alternatives, enhance adaptation efforts, and support technologies that can capture and store carbon dioxide will need to be directed to developing countries, where the impacts of climate change are expected to be most severe, and specifically to the so-called brown sectors of the economy at the level of SMEs, which according to the OECD account for some 40 to 60% of global carbon emissions. In this context, the champions continue to promote the work of the Sustainable Debt Coalition. Launched at COP27 and comprising 20-plus countries, the initiative aims to address critical intersections of debt, development, and climate change, to generate and widen the necessary fiscal space for developing countries. I would also take the opportunity to touch on the Regional Platforms for Climate Projects initiative established by the climate champions and related parties in 2022. Dario referenced this briefly in his remarks. The RPCP is designed to accelerate climate action and advance the SDGs by developing project pipelines and convening ongoing matchmaking sessions between project proponents and financiers, be they private or public, debt or equity, commercial or philanthropic. Almost 20 projects derived from over 450 collated have secured financing since COP27, with several of these supporting the energy transition. The belief is that with time, such pipeline development work can help give impetus to the sourcing and development of climate-related initiatives focused on transition finance, in line with the transition finance principles and taking into account regional priorities. Please do refer to the Assets to Flows 2 report launched by the champions on Friday for further information on this work. Thank you for your time. Adam.
Thank you very much, Nazim. Thank you, Dario. Thank you, Swed and Siegfried, for that very comprehensive introduction and to get us going in this conversation as well. Some of you may think we're a bit of an unlikely group of institutions to work together on this kind of topic, but I think it's worked very well, having both the public and private sector and the multilateral institution like the UN working together. And this comes back to that whole issue of partnerships and working together both at the regional and local level as well. So let's make a quick start on this. I think we're going to have a quick poll, so we make sure you're all an active part of this conversation as well. There we go. Okay. So one of the main instruments that we've talked about, obviously the EU is a real global leader now in the labelled bond market. Here is a bit of a poll to see what you guys will think will be the most, what was the word? Which instrument will dominate the labelled bond market by 2030? Will it remain green bonds? Will it be new instruments like transition bonds, target-linked bonds, social bonds, of course, I'm sure will continue to play an important role, or sustainability bonds? Or are there other instruments yet to be created by these innovative people out there? I'll give you a few moments to do that. Maybe while you guys are looking at that question, I'll quickly introduce our audience. I'm very pleased to have Anahita Toms, partner from Baker McKenzie, here on my right. We have Diana Aconcia, Director General for Climate from the European Commission, who's probably a well-known face and member of this seating panel here as well in the next 2 weeks. We have Bora Butchergods, Management Board Member and Executive Vice President responsible for Treasury, FI, Sustainability and Investment Banking at Denizbank from Turkey, and John Johnson, CEO of PKA, one of the large Danish pension funds. So a good selection of asset owners, FIs, private sector and public sector as well. Well, there we are. There's the answer. It will remain that green bonds will likely continue to play the dominant role within the labelled bond market. And maybe with that, Diana, I could come to you on the first question, if that's okay. Obviously, the EU, as we heard from Siegfried, is doing a lot to develop as an issuer the labelled bond market. But what else is the EU doing to develop bond markets within the Union, but also internationally? And how can the EU help promote the adoption and implementation of not only these bonds, but also the transition plans that may need to go with them as well?
Okay. Well, thank you very much. Good afternoon, everybody. Thanks for having me. Thanks to Sigrid, who proposed me to participate. I'm quite excited, actually, to be here with this diverse group of speakers from financial institutions. A bit scared also, because I am no finance expert, so I hope that what I'm going to say to you will make sense. So you asked me about the green bonds, what we do to promote them. First of all, I think in line with what the other speakers have said, green bonds have moved now from a niche trend to a big success story, to a key tool to mobilize transition finance. The EU is indeed the world leader, but not only with the next generation EU bonds that were described by Sigrid, but in general also of corporate bond. In the EU, 16% of all the issued bonds in 2022 were green bonds. Outside Europe, it's 2%. So there is a big difference that really shows the leadership. What we do to promote green bonds and transition plan. First of all, there are the green bond standards, on which I don't expand because something has been said already, but clearly the European green bond standard is also a world leader. It is a voluntary standard. By the way, it's officially published just last week. It was proposed by the Commission some time ago, but now it's out. It's built on international best practice and principles, where marketplaces will be able to use this standard to raise genuine green finance. So the no greenwashing, I think it's clear in the standard that we have proposed. It is based on the EU taxonomy, so it has a solid basis. It will have external reviewers, and will also be available to international issuers that want to issue green bonds. So that will also be a way to promote internationally. But going to how we promote internationally. Does this work? Is it okay? Good. So on how we promote internationally, then there is an initiative launched earlier this year, the Global Green Bonds Initiative. It was announced by Commission President von der Leyen and the Paris Global Financing Pact Summit last June. And it really aims at being a transformative initiative to support scaling up green bond markets in lower and middle income countries. Basically, it consists in an EU de-risked investment fund, being the largest of this kind because it's almost 2 billion, that will buy a part of green bonds that will be issued in lower and middle income countries. At the basis of this, there is a consortium of DFIs MDB from Europe, so it will attract EU investors into the fund by absorbing the first losses, and that will be backed by our EFSD Plus guarantee. I'm sorry that I'm going a bit technical, but basically they will be the anchor investor, they will buy the bonds, there will be a guarantee, and that should be an incentive for others to buy the bonds.
Don't worry about the technical, this is the experts
exactly.
here.
These are the experts, so this is technical for me, but they will know perfectly what we're talking about. But then this is accompanied also by capacity building and technical assistance for both the corporates and the sovereign that want to issue the bonds in the lower middle income countries. I am convinced that this is really, really a transformative initiative, and we hope that we will show fully its potential. And finally, how do we incentive the transition plans? We do this via the mandatory corporate disclosures on sustainability impacts, risks, and opportunity. This is at the core of the European Union Sustainable Finance Framework. And what is important about our disclosure requirements is that they have a double materiality approach. So they consider both the risk to companies and the impacts by companies. And if I am not mistaken, this is also the most advanced standard of this type in the world, because others don't have the double materiality. Transition plans compatible with the limiting global warming to 1.5 degrees, in line with the Paris Agreement, are at the heart of our climate reporting standard. So we expect in the coming years a scaling up significant of the transition plans, because the reporting requirements, according to our European Sustainability Report Standards, will start in 2025. So I think that I have already spoken enough. I don't know if there is the time to add a couple of other things on international, or otherwise I stop here.
We'll come back to that, because I know you've spent quite a bit of time in Africa, and it'd be great to get your experiences on that, and we'll also come back to transition plans and bring Anahita. But first I want to go to John. You talked about investors there, Diana, but also, are we able to have the Slido back up? But surely that's great news for you, isn't it? Because you just don't have to worry about transition washing, and you can just buy green bonds, because that's what will be the dominant asset out there.
Yeah, in 2030, so in 7 years. That's quite fast. I'm not so sure it will be that fast, but yes, that is a lot easier for us. I'm not so sure it's going to happen that way, but let me start. I heard, besides being the CEO of a small international scale, but though the biggest labor market fund, pension fund in Denmark, PKA, I'm also part of the GFAN's principal group, and I heard GFAN's a lot of times. So I think I will have to leave soon, because there's a lot of work we have to do. So we'll try to do our best. But first of all, I mean, this is all down to, I mean, we just 2 weeks ago, together with my board, I had sort of a workshop for half a day on whether to exclude, to engage, or to work also with transition finance. And I think this is about maturity of how we see things. So that has changed. For many years, PKA has been sort of a leading investor together with another Danish pension fund in the green transformation, investing in solar and wind and so on. And we now have 15% of our balance sheet, our asset under management, invested in the green transformation already, so in all across America and Europe. So we've been there for a while. But the way that my fiduciary role to my members has been, and the way they see things before, was that you have to exclude things. You shouldn't be into gray or brown or whatever industries. You should try to avoid them if you can. It can be hard if my tracking arrow should not be too big to the indexes, but that's been sort of the main focus. But now it has actually changed, and not even without knowing that I was on this panel. So they are very focused now and understand that we have to change, and to change, we need to put money in industries that need the money to transform and to do the transition. So they really support it.
So you're really seeing that change from the binary sort of green and brown to a realization that we need to go across the whole rainbow, as it were.
Exactly. We're maturing in a way. So now we understand it's not a binary thing, one or the other. We need the transformation. So now it's up to me to find the best way to do it, and it's a hard job, but we'll try.
Okay, good. And I hope you're getting less transition washing questions at the AGMs as well. So.
At the AGMs, maybe not, but at the board.
All right. We touched upon transition plans, Anahita. Well, I'd like to bring you on here. I mean, just as a warm-up, it'd be great to share a bit more on what you do at Baker McKenzie towards transition, but also how do you work with industries, and not just the hard-to-abate ones, the heavy industries, but how do you make sure everyone is included? Just to give an introduction to the work you're doing as well.
Sure. Yeah. I do believe that we really need to bring in every industry. So energy, obviously. You mentioned aluminium, steel, aviation, obviously. But that's not enough. We have to bring all the industries together because it's such a
maybe you should hold the mic, Mike.
Big challenge to handle. When it comes to transition planning, I think we have to appreciate that the European Union is well ahead of others. So we have the CSRD, obviously, with very concrete reporting requirements. We have the CSDDD coming in likely soon. It has been delayed several times. Article 15 elaborates, again, on transition planning. The challenge, though, is this is not global. And although we have the ISSB working towards global standards, we have to appreciate that we are here on an EU level. So what I would say is what is critical is who is reviewing and against which standards. So the supervisors that enforce will be European, obviously, and the standards against which we are looking at are European again. So I think what I see with companies struggling in the European Union is we have the regulatory environment, others don't. So I think my first thing to share with you is some skepticism around how will we in the European Union set standards, and maybe we will be the pioneers, hopefully, but some question that. So I think that is definitely something I can share with you. When we look at laws, and I just want to draw an analogy to environmental laws and the German Supply Chain Act. Before we had the German Supply Chain Act, actually, only 17% of German companies that fall now under the scope followed the UN guiding principles. Now, obviously, with a hard law in place, that has changed. But again, German companies are saying there is no level playing field for us because there is no CSDDD and there is no US law equivalent. There is no Chinese law equivalent. So I think it's really important to be ambitious, but always be aware of the challenges if you just look at one region instead of global standards. And the ISSB is a hopeful thing, I think.
Thank you very much, Anahita. I mean, something that Suad brought up in her opening remarks was about that transition plans may become a sort of a license to operate for corporates and other organizations. Do you think that's something that could happen in the short term?
Of course, I mean, obviously, if you have hard laws, it is, as Suat said, it's going to be a license to operate. But as long as you don't have hard laws, I would question that we will see it on a global scale. We see it on the European scale because there is a push and there is also a convinced, like people are convinced we need this. But again, there I would differentiate between sector and sector. Who is able to do what and to what extent? I think that is a critical point to always keep in mind when we have laws. Who is going to, implement them and who is going to enforce them? Because those who enforce them are, in my humble view, also a little bit overwhelmed by the different laws that are coming into place at the same time. So interoperability is key. And the other thing is global standards and global understanding. I know it's a hard thing to achieve, but if you want to bring all the sectors in, that's a key thing I would like to reiterate.
I agree, and that's why we're all here, I think, as well, to achieve something like that. Bora, if I come on to you, obviously, Denizbank in Turkey as well, you're at the crossroads of Europe and MENA, the region we're in for this great conference as well. Maybe if I can refer to it as MENAT, to include Turkey as well. I mean, this region has one of the most climate vulnerable regions in the world and has suffered very big catastrophes in the recent years. But how does this region that obviously relies on a lot of heavy emitting and hard to abate sectors for growth, how does it transition?
Thank you. Yeah, actually, I'm very excited to address such esteemed audience together with industry experts. So I think I can be the voice of emerging markets in this panel only. And also I can give some color, take out my background, markets background. I can give some color on that as well. So first of all, I would like to state that, as you well know, emerging markets has significant disadvantages. When it comes to access to finance, access to funding, cost of funding. When we are talking about fundraising, emerging market costs are significantly above the developed markets for well-known reasons, be it political, be it whatever. So having said that, I'm an optimist, and I believe emerging markets has one big advantage over the developed markets. This is their, by definition, their adaptation power. So coping with, dealing with global crisis, local crisis, political and geopolitical issues, I believe over the time, emerging markets developed and still developing a transformation power, which will help in our efforts in this transformation of our climate issues. So, the word transformation is usually associated with two keywords. On one hand, you may say it should be and there should be an orderly change, and on the other hand, it should be gradual. It's normal. This is transformation. Having said that, for the time being, when it comes to sustainability, when it comes to climate, our Earth, the future of our world, I don't know whether we have enough time, to do it in a gradual manner. So, and this the whole restructuring of our global economy, will be in a scale of like the industrial revolution in the past, but at the same time, it should be that much quick, like a digital revolution. It should be as speed as the digital revolution. So, but we should not find any excuses in order not to go for it. And the financial sector, all, including the emerging market financial sectors, we should be fully comply. It's inevitable. We should do it for our kids, or we should do it even for ourselves. So under these circumstances. So for that reason, as per Denizbank and for the Turkish financial sector, I believe, first thing first, we should establish an infrastructure and capacity building mechanisms. First of all, we should measure. Without measuring, we cannot manage it. So it's a kind of a precondition to manage our transformation efforts. In this respect, as per Denizbank, we established four key pillars to build our infrastructure. First of all, we are assessing our loan book. I mean, from environmental and social perspective, not only our project finance big ticket loans, all of our loan books, maybe excluding retail loans at this stage. So the second stage, we are integrating climate risks into our risk methodology. We are cooperating in this field with IFC and EBRD. Our beloved supranational counterparties are supporting us, assisting us in this respect. The third one, for sure, we have to measure our carbon footprint, but behind that, we should measure our finance emissions as well. Our customers' footprint is very much important. I will touch that as well going forward. So in this respect, we became the first Turkish bank being a member of PCAF, Carbon Association Partnership Facility. We are proud of that. And finally, last but not least, we finalized our sustainability framework as well. So it's a future-fit, robust framework. This will help us transform our customers by innovative and green financing alternatives, especially in our niche sectors. As per Denizbank, from the establishment, we selected some niche sectors. These are health and education, infrastructure, energy, agribusiness, tourism, and shipping. So to some extent, these are all fit our sustainability efforts, globally speaking. So for that reason, going forward, we are also in Turkey, we are the first bank to include agriculture and food safety category in our framework as well. We got a rating from ISS, second party opinion from ISS. So we are on track going forward. And up till now, we raised $3.4 billion from our supranational counterparties under 50 different facilities, mainly addressing sustainability efforts, agri, SME, solar, women in business areas. Plus, we have $2 billion outstanding syndicated loan. And all the KPIs has related to environmental and social factors. So I can going forward what we would like to do, but I don't know.
Let's do that. I'll come back to you on that,
Okay.
on the outlook. I'd like to do another round of questions myself, but I'm collecting questions through the Slido, so keep them coming, and I will address those to the panel in a few moments as well. I suppose going on to, not really emerging markets from Bora's introduction, but let's develop that theme a bit. Diana, we mentioned it a bit earlier. You spent a bit of time in developing markets. It'd be great to hear your views and understand how the EU adapts its climate diplomacy with emerging markets like those in Africa, and how can it better use its green partnerships to support the low-carbon transition in the global south as well.
Thank you. So that would be... I could talk for hours about this issue, but
You have 5 minutes.
I will try exactly to be very focused. I think what I could say in a very non-technical way that we have discussed today is that basically money is there. I don't think we are talking about a scarcity of capital of finance, but the capital does not always go to the right sectors, and most of all, very often doesn't go to the places which are most in need. So about the right sectors, I think that here I have the experts that talk about it, is that the transition finance and sustainable finance needs to guide us. So here I want to focus on on the places. How we bring finance to the difficult places where very often private investment doesn't go. What are the problems? The problem are the business environment, which is very often not conducive to investment, and not only the green investment, but to all types of investment, because of uncertainty of regulation or corruption or political instability, you name it. And this is linked to the risk of this market, which can be a real or a perceived risk, because maybe the perception of risk in a market is even higher than the real risk will be, because there is lack of knowledge, because there is uncertainty. How we tackle this problem? I think, first of all, we promote structural reforms in the developing markets to make sure that the business environment is there. We have a lot of technical assistance from this point of view. We assist countries to create legislation, regulatory framework. We work with the other actors on the ground. For example, the International Monetary Fund, they do a lot on this, the World Bank, all those that can work together with us to this purpose. The second point, which is perhaps the most substantial, is then the risk investment directly. The European Union has its flagship strategy to engage with developing and emerging market, which is the Global Gateway, which is an investment plan of the European Union, the EU member states, together as Team Europe, and the European IFIs and MDBs together. It's a plan to invest 300 billion between now and 2027. 150 billion of each of these should be in Africa. The idea is indeed to de-risk investment. The Global Gateway is part of the Global Gateway is the EFSD Plus fund, which I mentioned before, which is giving guarantees to the banks with public money, with EU money, giving guarantees to invest in risky markets. And we also use a lot of other instruments, such as blending between public and private finance. And the Global Green Bond Initiative that I mentioned before is part also of this bigger Global Gateway package. Another point I would like to mention is the partnerships that we develop. An important one that we have is the Just Energy Transition Partnership, so that we have at the moment with South Africa, which was the first one launched at COP26. And then we have with Indonesia, Vietnam. There have been events today and the day before, 2 days ago with also President von der Leyen on Indonesia and Vietnam. And the last one was with Senegal, which was launched in Paris in June. The idea of the JETPs, as they're called, is that the EU joins with the other partners. The basis for JETP is G7, but other donors, public and private, are very welcome to help countries that embark in an ambitious transition from a emission-heavy power system, particularly countries that rely very heavily on coal, towards investing massively in renewable energy. It is a very challenging but also very rewarding context, because these countries are coming out themselves with ambitious transition plan, and then the donors fund them. So it is big, and we hope that soon we will see the first investments mobilized under the JETPs. We had a very successful event with Vietnam, with the president, as I said, where Vietnam presented an ambitious resources mobilization plan. Last point, very briefly, is we look for champions. There are countries in Africa that are more advanced than others, that have committed more strongly on the transition. One of them has been very visible at this COP. It's Kenya, which was also the host for the Africa Climate Summit, which has promoted the narrative of the green transition as a huge opportunity for Africa, which I completely agree with, and I really hope that this is going to be the occasion. But there are also other partners. There is Morocco, that is a partner with the EU. We have a green partnership with Morocco, which is a comprehensive partnership where we commit to be ambitious and to cooperate not only on climate targets, but also on environment, on energy, on sustainable finance, on research and other policies that together can be the equivalent in these partners of the Green Deal, what the Green Deal is in Europe. And we hope that these champions can be the example for others that, particularly in Africa now, are still a bit uncertain because they rely very heavily on fossil fuels. But we hope that these green diplomacy examples can then encourage the others to follow. Thank you.
Thanks, Diana. John, I mean, those kind of projects, how interesting are they to an investor like yourself?
I think many of these projects are actually interesting, but we're just a pension fund, and some of the issues for us is that we don't have the knowledge and insights to drive these type of investments. So what we've done before is that we have actually set up companies together with other pension funds in Denmark, or we have, if we go to emerging and developing economy, work together with the Danish state on their DFI, the IFU it's called, and done investments in emerging and developing economies, because you need people on the ground that really knows how to implement these types of money and all the contracts, and you have lots of things you have to, the FX risk and many things you have to take into account.
Is there more institutions that the EU can do to attract investors like you into these kinds of projects?
But let me start. Can I start at another place? I think I must compliment EU because this is maybe not something that you will hear from many leaders in the financial sector or in any sector. But I really think it's so good that EU set up all these type of regulations around this. It's so the CSRD, the CS3D. It's super important. It's like the GDPR. I mean, of finance. It is. And let's have a look now. GDPR is something that even American companies implement. So if you are on LinkedIn or Facebook or anything and you want to sell your products in Europe, you have to live up to the European GDPR regulation. And I think maybe not in the same practical way, but I think that the EU will actually set standards. And with those standards, it is a lot easier for a pension fund, not only us, but other pension funds also, to do these type of investments. So I'm really in favor of regulation. My colleagues are not always, do not always agree with me, but I do actually love regulation.
That's right, an investor calling for more regulation. Good.
Yeah, exactly.
In this area.
All right, let's come back to the transition plans. Anita, I'd like to bring you back in. I mean, here, we haven't touched upon SMEs, really. I mean, they make up the vast majority of most economies around the world as well. How can SMEs take advantage of the finance support and efforts that regulators, but also investors, are making towards this transition?
I think I would start by saying that SMEs are not always under the scope of the regulation, but the trickle-down effect leads to the fact that many SMEs have to comply with laws indirectly. Because the bigger companies, what do they do when it is about supply chain compliance? They hand it over to their suppliers, and they may only have 100 employees or 200 employees, so they are affected too. This is the legal part. The factual part is that investors too, and other stakeholders will look at the SMEs as well from the lens that they are used to with regards to how they look at bigger companies very often. So I think, first of all, we have to acknowledge the challenges of SMEs and then see what can they do on their end. And I think if you look at the German Sustainable Finance Advisor Council, which Frank Scheidich is part of, you can see that they advocate for knowledge sharing. Make sure that you really understand what are the opportunities, because very often the SMEs don't know. Secondly, I would say policies and also public-private partnerships. So I think these are the key things that I say. It's not just the SMEs to take the opportunities, but also we acknowledge that standardization must be in a way that SMEs can fulfill their obligations. Otherwise, they run into inaction, resignation. So due to the trickle-down effect, they have to do more than legally required. So let's help them with more standardization.
More regulation, more standardization seems to be the theme. Bora, you were going to come on to how DenizBank is transforming itself into more of a sustainable financial intermediary.
Exactly.
This is obviously a key thing for financial institutions like DZ Bank as well. We are changing our business models, and please share a bit more on how DenizBank is doing that as well.
Thank you. Yeah, actually, going forward, what we are planning to do, I mean, first of all, of course, providing more green loans reducing finance emissions are the main agenda items like everyone else. And also a sustainable strategy build up in order to manage hard to abate sectors as well. So, but on top of this, and maybe more importantly, what we can do in a unique manner, more unique manner, I believe digitalization and new generation banking is also key to transformation as well. So for the time being, all of the banks around the world are very proud of how digital they are. In DenizBank, 96% of the total transactions are from digital channels right now. But it's not that we should do something more, I believe. So, for example, in DenizBank, we established a subsidiary, an IT-based subsidiary. It's a new age software and IT advisory subsidiary. The main aim is to support fintech startups by either investing directly or help them accelerate their business in our incubation center, etc. So the main aim is innovation and ecosystem collaborations to build up. And in that respect, we invested to a fintech startup, which is mainly dealing with sustainability issues, named Erguvan. Erguvan, they're also here. Tomorrow, during the week, we will do some panels with the Erguvan colleagues, and they will tell their products and solutions in here. But basically, Erguvan is on one hand calculating a carbon footprint of corporates and financial institutions, a local company, fintech startup. And on the other hand, you know, the voluntary carbon markets should grow more. And they also establish a voluntary carbon market platform so that Turkish corporates can buy and sell their carbon excess or carbon deficiencies in that respect. And moreover, for example, we have an electricity company, Ecos Electric, our customer. They are producing equipments and they are producing SF6 emission gas as well. So we introduced them to Erguvan. They work together. And now, really, it became a case study that their now carbon emission is much less than before with the help of the Erguvan. So, and also we will make a panel on that as well in the coming days. Apart from that, we are cooperating with another fintech called Depar. They are working on a marketplace to optimize supply chain cash flow and create low-risk transaction environment, mainly for SMEs. And going forward, thanks to our leadership position in the agriculture, we are supporting agri-fintech startups. Especially, we are supporting digital tools, which may increase productivity in the agricultural sector. And also, traceability is quite important as well. So all in all, our aim, as per DenizBank, we are a relatively small bank, but together with ENBD, I should say, our aim is to open up our sustainability-linked fintechs to the global world. And in that respect, finally, I would like to say that on December 8th, at the Climate Finance Hub stage, our subsidiary NeoUp and Oxford Technology arm, Oxentia, will launch a climate tech accelerator jointly, and we will be making a signing ceremony. So we welcome all the audience in order to share us in this nice event. So, I mean, I can't stop here.
Oh, thank you, Bora. I mean, you brought up voluntary carbon markets, a very important area for development. This was something that was discussed in our high-level event earlier this morning as well. It was described sort of as a Wild West area, especially in emerging markets as well. So this is definitely somewhere where needs more standards and regulation. And maybe this is something that the group of the coalition of the willing, as it were, the DZ, UNEC, and the high-level climate champions in the EU may look into at a future date as well. I'm not, obviously, there's no firm commitment to that, but that's just a suggestion from the floor. I'll bring in some of the questions from the floor here. This is a question to all of you, really. How can we ensure that the speed of transition finance does not get tampered by fears of transition washing? So basically, how do we balance the speed, innovation, financial innovation, but fears over transition washing? Who would like to tackle that? Or I'll call on someone. John.
Okay, I'll try then. It is, of course, a hard and a tough question because how do we keep the pace? I think in many ways that we are already, you know, on the move, at least when I look to Denmark, I mean, the maturity in the whole sector is now not the sort of the binary view on things. It is sort of a more complex view. We understand that transition finance is an important thing. I think if we want to speed things up, I have maybe a little bit of a controversial thing I would put forward. I mean, I think a lot of the questions we're talking about here, a lot of the answers can be found in carbon emission tax, because then the financial dynamics will work all by itself. Money will flow to good ideas, to companies that are willing to do these type of investments. So I really, really think we should do something about that, but I know it's a very complex thing to agree. And I know at least Denmark is now trying next year to implement carbon emission tax, and I can already now see initiatives being started up, asking for money from pension funds like us, long investments in interesting areas. So it works, but I know it's so it's just if we want to speed things up, I think carbon emission tax is the answer. And we can look into the very, very good initiative, the so-called BEPS program from OECD about minimum tax on companies worldwide. You have the whole scheme there. It's just a copy-paste.
Well, there we go. More taxes in Scandinavia.
Yeah, I know.
Anahita, how would you advise your clients on this balance?
So maybe it's worthwhile to share some insights from private practice, and I think Saud also alluded to it. What we're seeing very often is actually divestments. So there is a brown asset, how can I quickly get rid of it? But we never transformed it. And the new owner doesn't transform it, maybe also because it falls under a different regulatory regime, which is actually the worst case scenario. So if we take that, we see that what you're elaborating on is actually a very real challenge in practice. So portfolio companies tend to say, I want to be the first one. I want to be greener. So let's get rid of the brown assets first. Is that the right way? And it's one of the most uncomfortable truths that people very rarely want to speak out. If you really want to make a difference, you have to keep those brown assets and make it better.
No, I agree. That's that whole transform instead of divest mantra. That's something that DZ Bank works towards as well. I suppose one more question here from the audience as well. To what extent to what extent can finance, obviously we're talking about transition finance, but for finance players like all of us here, to what extent can we contribute to the limit of climate change, or is it up to individuals just to change their lifestyle choices? Dana, you represent the largest population here.
Okay, thank you. I think it's very difficult in this moment for any politician to talk about lifestyle changes. It's difficult in Europe. It is even more difficult in other countries. Among other things, I negotiate climate. I represent the EU in the climate groups of the G20, and the Indian presidency had at their flagship initiative something which was called Lifestyle for Environment, that should be like India inspiring the rest of the world. And one of the elements is indeed the individual lifestyles. And we there realized that among the advanced economies, there was a divide there between the European Union that with some caveats, like we cannot put all the weight of the action on the individuals. It has to be, we as governments need to take our responsibility. We cannot put it on people to change their lifestyles if we don't create the right system of incentives. But there were other countries that were allergic to the idea that individuals have to contribute to climate change, that you as state have to ask the citizens to make any change in their lifestyles. But this question will come. It will come because we see in Europe, being the leaders of the transition, that by 2030 we will have probably decarbonized a lot our energy sector. So we will have done the easier bit of the transition. Then come the hard-to-abate industries. And there we already talked about it, that their finance can do a lot, indeed, in supporting these industries in decarbonizing, but it will take more time. But even when all this is on a good way, there will be other sectors which are really very, very difficult to decarbonize. One is agriculture. And there we get into the consumers' habits, because to decarbonize agriculture will mean that we eat drastically less meat than what we are eating now. We are eating, apparently, according to WHO, 40% more of the meat that we need. And if we free the land that we are now using to produce feed for animals, then we can produce food, and we can also probably restore some of this land to the nature, according to the nature restoration law, that not by chance is encountering enormous opposition in Europe. And this is not a good moment for politicians to tell difficult things, to speak difficult truths. There is, as you all know, in Europe, we are having a backlash against too much Green Deal regulation. So not everybody agrees with you, unfortunately, that we need more regulation. A lot of people want less. Because we are now going into what requires sacrifice to the individual by the heat pumps, the heat pumps crisis in Germany, because all of a sudden the citizen is realizing that something will have to come from their pocket. The solution will be very close, support very strongly the groups which are more fragile and more exposed. But even doing that, the European Union does the regulation, the member states have to implement the support, and not always this meets in the right way. So I don't know if I completely answer your question, but I'd say to the individuals, we will have a huge responsibility, but it is the responsibility of the government to create the right incentives and the right protection from fragile groups and the right incentive for the finance to go to the right place. It's an enormous responsibility, but we will have to take it.
Oh, Diana, thank you. That was a good answer. You did very well in not answering the question, but giving us other answers. Very good. But anyone else want to tackle that?
Yeah, actually, I very much agree with my friends. So this is not an area where free market dynamics will not be enough. There should be some kind of regulation. The only downside is that the regulators should be very much aware of the limitations, especially, for example, in agriculture. We are not only talking about, yes, it's a hard-to-abate sector to a great extent, but at the same time, we have food safety, security, we have immigration issues that we must take care of. So it should be a very careful, very smooth regulation.
Okay. I think with that, we'll start to wrap up the panel. We do have one more Slido poll, I think, if we're able to get that. Oh, there we go. So yeah, here's it. I thought we could end with this sort of a pondering question to keep us thinking for the next few days. But yeah, what do you think is the most important to attempt to keep 1.5 alive? Does it mean more improved methodologies, providing the distribution of finance, so more platforms and initiatives to get finance in the right places? Do we just need to increase finance to the developing world? Or is it even a simple thing like the operationalized, if you not as simple as saying, but getting the loss and damage fund working, basically. All right. Well, there we are. So I thought the second one wouldn't be as close. But yeah, so it's both improved platforms, methodologies for getting finance to the right places, but also increasing the amount of financing going to the developing world, or these risky markets, I think, as Diana mentions, are some of them as well, which do need support to attract in investors and finance. Well, with that, I would like to thank our panel for your time and for putting up with my questions and off-cuff questions to keep you on your toes. And I would like to pass on to Siegfried and Frank to provide some short closing remarks.
Encourage you to work on the challenge, to deal with the challenge of climate change and to bring some optimism here to this discussion. Now I want to give you a challenge, Frank. can you take an optimistic summary here? What is your conclusion? What makes you optimistic that we will be able to manage it?
Thank you, Siegfried, and thank you, DJ Climate. Thank you very much to make that happen here. What takes me optimistic? I'm always optimistic, by the way. I like to be that, and I like to see the glass half full instead of half empty. And we heard a lot of good things here then, yeah? I liked your one, Jon, where you asked for clear guidelines and regulations, because regulation not necessarily is negative. It can be used, in America as a good example, also for the good. And this is something I can't be more than agree with, because then you know what you're dealing with. Then, yeah? And it leaves not much room for cheating on certain things, like we have seen. One of my really most important topics I try to chase personally with my colleagues is to have a voluntary carbon trading system in place, and not the 47 ones which exist already. Yeah, they might have a domestic impact that little, if at all. And we have to agree on at least in the major 3 time zones. And I don't want to talk in borders. I really want to talk and encourage you to think in time zones. Think about, we here in Europe, together with Africa and the Middle East, we sit in a sandwich position. As long as the world turns as it turns, we definitely come directly after Asia Pacific, and then we pass on to Americas, North, Middle, and South. Hey guys, this is our chance, because we can serve them all. And that's what we should do. So far, I heard the biggest action in our time zone. Yeah, what has been done, whether it was the public or the private sector. And the pension funds, as one of the major important investor groups, just one positive example. We sometimes underestimate the power of finance, and our politicians, sorry to say that here in such a public environment, have hammered on us, and they made a big mistake. Because if you see the other 2 major time zones, how important that is to be the disc, the bridge, the solid bridge you can walk through in between the real economy, science, and the politicians. And that's what we have to think of. And I can't be more than agree also what Anahita said then, yeah, and try to guide us. Take action on the SME side. And because for them we need to have this voluntary carbon trading system in place. Obviously, like you said, Jon, it has to be a clear condition we all can cope with and the people can rely on. And on the other hand, it should be guided us through a supranational fund, which doesn't exist these days, an impact fund for action for, in particular, the SME side and all the municipalities in the world. And that's where the carbon output comes most from, more than 50%. And if we give them a chance to tackle that risk, then we definitely have a step further. And that can be implemented within the year. And this year, the presidency being passed on from Egypt to the UAE. And I heard the rumors that might be there's another one coming up soon, but we will see. At least in these 12 months, we all together, all the 4 corners, science, politicians, real economy members and financial members, they can do it together and they will achieve it together. I'm pretty sure. Thank you very much, and I hope we will see more of those. Thank you.
Yeah, thank you, Frank, for finally sharing this vision of the future. I think this can keep us or leave us with some optimism. And for me, what is left is to say thank you. Thanks to you, our audience here in the room, at home at the screens. Thanks to our speakers for supporting this initiative. Thanks to UNECE, to DZ Bank, to the Climate Champions for the great cooperation in preparing this event. And also, let me mention the colleagues from DG Klima who are managing this pavilion here and gave us the floor for this presentation. Thanks for your support and enjoy the rest of the conference. Thank you.